Adapt or die.
In the last couple of days, this has been one of the worst weeks for equities of the year. Now this doesn't mean we're going to have an absolute crash next week, but things have started to kind of roll over a little bit. We'll see where it goes from here. But the Dow was down this week. The S&P was down this week. The the Nikkei topped and started to sell off. The DAX, which is the German stock markets, topped and started to sell off. Apple, which is a bellwether, had a huge drawdown this week. Nvidia, which is the best performing stock of the year, I think, or at least one of them, and certainly the driver of the AI boom, is it had an okay week, but it's kind of sitting right at the support level technically. So it's going to be and then in the last, not only that, but we're talking about the bloodbath and bonds this week, and I think the long bond was down like 4 or 5% at one point this week. Now today it was up 1.5% to 2%. So I think it finished the week down 3%. But this morning when the non-farm payrolls came out, it was kind of a Goldilocks number. It was anybody could find whatever they wanted to in it, but it was kind of a benign kind of Goldilocks number. And markets were up. In the morning, markets were up anywhere from 0.5% to 1%, and then around 1 or 2 o'clock, things started to sell off, and it kind of became a crescendo by the end of the day. Now, again, it's not necessarily Armageddon yet, but the bond market turned around. I think the long bond ended up being up 1.5% today. Equities sold off. A lot of them broke some technical levels on the weeklies, and so right at the time where liquidity, and we talked about this is the point where liquidity starts to disappear. So, and not only that, but it's, we talked about the lag effect of the interest rate hikes, right? The lag effect from the inversion of the yield curve. So again, we're starting to see all of this stuff come together right at the time where we said it would probably come together. Now, I think next week is going to be very interesting, because this has happened many times this year where you get a little bit of a pullback and then they just rocket to new, everything rockets back to all-time highs. But we're kind of at this place again where it could very well bounce and go higher, but it could also, if it starts to break a little bit more from here, you start to get some technical damage, you get liquidity drying up, a bunch of hedge funds that had been short and were struggling, then got long, and now they get hit again. I mean, and we're going into the fall. That's the other thing. Like, bad things always seem to happen in the fall, or at least when bad things happen, it always seems to be the fall. So, now we've got, a lot of people are away on vacation. The main people that run the desks are gone, and it's the junior people sitting at the desks. We've got an inflation number in the next couple of weeks, and then don't forget we got Jackson Hole at the end of the month. So, all of this stuff, the timing is it is very interesting.
I think I could see in the future us one day recording live from Jackson Hole. Can you imagine?
That would be great.
Milkshakes at Jackson Hole.
Let's just do it. Next year we go to Jackson Hole.
Sounds like a plan. So you were just discussing all these variables around liquidity. And for those who don't know, Brent Johnson is a avid waterman and lover of the ocean. And when I'm thinking about what has been going on in the bond market, one of the things that happens when there's various predators in the ocean, if you ever experience attack by one of these, most people don't die from the attack. They ultimately end up dying from a slow bleed. And so maybe we've had this slight bounce back at the end of the week. Maybe that's a cauterization of the wound, but it feels like the bond market has kind of permanently lost a limb here. It's really struggling to find its footing. I guess no pun intended in this case.
Yeah, and here's the thing with I should address this, is I think a lot of times a lot of people tend to know my dollar views, and I think they kind of conflate that with bond views. I am really kind of indifferent to bonds, especially the long term. I have several friends who are super bond bulls, and I completely understand their argument, and I don't necessarily disagree with it, but I'm not playing it in my client portfolios. And here's the reason is because I'm just not sure. And the second reason is that part of the reason I am a dollar bull is I think in general rates were super low for 5,000, or they were 5,000 year lows, and I thought that they would have to rise. And counterintuitively, when interest rates in the United States rise, that makes the dollar stronger because people already have to own the dollar anyway to operate on the global stage. And if you get paid a higher interest rate to save your money in dollars, it just makes dollars even more turbocharged. So I don't need the 30-year bond to do well in order for my dollar thesis to play out. The other thing is that if I were to be playing the long end of the bond and you get it wrong, you get a week like this week, right? I mean, down 5% in a week. That's not really what you want your safe part of the portfolio to be, down 5% in a week. The other thing I'd say is a lot of people will say, well, why would you ever buy a 30-year bond anyway? You only get 4% a year for 30 years. Well, most people that buy bonds and most of these bond bulls that you see, they're not planning on buying bonds and holding on for 30 years. They're planning on buying bonds this year. They think interest rates will get cut next year, and they're not going to make 4%. They're going to make 40% if that happens, right? I mean, that's one thing to remember is you don't have to hold a bond for 40 years just because you buy it. But the reason I'm not in long bonds is, number one, I just don't know. I'm first to admit that I just don't know whether rates are going to rise or going to fall. I tend to think they're going to fall, but I don't know. And the other thing is that in my part of the bond portfolio, I keep them at 5 years or less, and I'm heavily into treasury bills right now because you get 5%, over 5%, you get ultimate liquidity. There's nothing more liquid in the world than treasury bills other than potentially gold. And, you know, will I get as big a pop if interest rates fall, 250 basis points? No, but I can use if interest rates fall 250 basis points, something else is probably getting murdered and is probably completely beaten up. And then I can use my treasury bill liquidity, which is paying me 5%, to go buy some really cheap stuff. So that's kind of why I am avoiding the long end. And, it's not a judgment call on what anybody else is doing, but it's just kind of the way I think about it.
Yeah, I appreciate the context on that. And just to make it clear, what people are actually playing is they're happy to collect that short-term yield on whatever duration they're playing, but the hope is that they're going to profit on what the price of the coupon does. So it's very much a bond, speculation. So that speculation's been getting beaten and bloodied quite a bit, and it's certainly been a theme so far, this bond bloodbath. But to add some color and context here, something you've always said and just referenced it again, when interest rates are rising, this is typically good for the dollar. We talked last week about the carry trade, very, very early episode number 3 in this year. We focused on that in an episode called Japanese Jawbone Roulette. So between those two episodes, you can get a really good sense of why people would be investing in the U.S. markets if interest rates are going up. And that's one of the reasons they have the other currencies that are falling against the dollar. They've done these carry trades. So it's super important to remember. You've also highlighted earlier in this conversation how although the U.S. is in a tough spot, and certainly there's a lot of risks going on as far as, the deficit and trying to manage the budget at these higher interest rates, we never issued negative bonds. And so as much trouble as the U.S. might potentially be in a serious crisis, look around the world, and as you've always said, it's a relative game.
Yeah, I've said many times I am not a fan of central bankers, and in many ways I think they are the group that is the smallest. They are the smallest group that's done the most amount of damage to the biggest group of anybody I can think of. I think I've told you this before. My friend Alex Gurevich said, "Have you ever heard of the Soviet Politburo?" When I said that. So I'm not a fan of central bankers, but I will say the one thing that if I had to pick one thing out that the Fed has done right, or that has put them in the position they are now, is they did not take interest rates negative, and they had all the opportunity in the world to do it, and they didn't do it. So I do give them credit for not going down that. That's a path to that's the path to hell right there, and you're going to see it in Europe and Japan. You can't escape from negative rates.
This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.